Welcome to today's session on stock market. Whether you're curious about investing or just want to understand how stock markets work, this is your first step into the financial world. Let's uncover what stocks are, who the key players are, and explore the stock exchanges. Stocks, also known as shares or equities, represent ownership in a company. When you buy a stock, you are essentially purchasing a small piece of that company. As a shareholder, you have a claim to a portion of the company's profits and assets, although the extent depends on the number of shares you own. The more shares you have, the larger your stake in the company. The stock market is where these shares are bought and sold. Think of it like a giant marketplace where people trade pieces of ownership in businesses. Companies go public and issue stocks to raise money for growth, and investors buy those stocks to gain a share of the company's potential success. The price of stocks fluctuates based on supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell, the price drops. Key participants in the stock market. There are four main participants in the stock market. Investors. These are people or institutions who buy stocks with the goal of holding them for a long time. Investors believe in the company's potential to grow, and they're willing to wait patiently for their stocks to increase in value. Traders. Traders, unlike investors, seek to make quick profits by buying and selling stocks frequently. They take advantage of short-term market fluctuations, buying stocks when the price is low and selling when the price is high, sometimes within minutes or days. Brokers. Brokers are intermediaries who help investors and traders buy and sell stocks. They provide access to the stock market through platforms like apps or websites. In the past, brokers were human middlemen, but now many operate online with minimal fees. Regulators, regulatory bodies, such as the Securities and Exchange Board of India, (SEBI), oversee the stock market to ensure it operates fairly and transparently. They protect investors from fraud and ensure that companies and brokers follow the rules. Think of the stock market as a big game of chess. Investors are like players planning long-term strategies. Traders are those looking for quick wins. Brokers are like chessboard makers providing the platform, and regulators are the referees ensuring the game is fair. Stock exchanges. In India, the two main stock exchanges are the National Stock Exchange and the Bombay Stock Exchange. NSE, National Stock Exchange. The NSE is one of the largest stock exchanges in India and is known for its modern technology and higher trading volumes. It offers a wide range of products, including equities, derivatives, and bonds. BSE, Bombay Stock Exchange. The BSE is Asia's oldest stock exchange and still remains a key player in India's financial markets. It is home to many of India's biggest companies and also offers a platform for trading stocks and other securities. Stock exchanges provide a safe, regulated space for investors and traders to buy and sell stocks. Companies list their shares on these exchanges, which means their stocks are available for the public to trade. Imagine the NSE and BSE as giant shopping malls where companies set up stores, their stocks, and you as an investor can walk in and buy what you like. The stores are constantly changing their prices based on how popular their products, stocks, are. Overview of indices. Nifty 50 and Sensex. Stock market indices provide a snapshot of the market's overall performance. The Nifty 50 and Sensex are two of the most important indices in India. The Nifty 50 is an index that tracks the performance of the top 50 companies listed on the NSE. It is a broad representation of how large-cap companies in India are performing. When the Nifty 50 goes up, it indicates that most of these top companies are doing well. The Sensex is an index of the top 30 companies listed on the BSE. Similar to the Nifty 50, the Sensex gives a quick glance at the overall health of the stock market by showing the collective performance of these leading companies. These indices are calculated based on market capitalization, meaning they take into account the size of each company. Larger companies have more influence on the index. So when the stock prices of big companies rise, the index goes up, and when they fall, the index goes down. Think of the Nifty 50 and Sensex like the pulse of the stock market. If most of the top companies are doing well, the pulse is strong, indicating a healthy market. If the pulse weakens, it shows that the market might be struggling. Thank you for joining today, and I hope this introduction has sparked your interest in learning more about the world of finance. Start small, keep learning, and soon the stock market won't seem as intimidating. Happy investing!